as we're thinking about sort of our own portfolio in 2021, a lot of investors obviously would be buying some equities in their portfolio, definitely understandable, but you need to have a ballast in your portfolio, right? And typically that was done using fixed income, using bonds, right? As we all know, bonds don't work anymore. So I think this idea, and I was talking to a strategist colleague of mine, and he basically equates buying government bonds today as buying insurance. The fixed income portion is no longer fixed, right? You basically have to pay in terms of negative yields in many markets. You basically have to pay for protection. So bonds have become kind of insurance policies. But the thing is, for us as investors, we still need to generate yield because ultimately, if you can't beat inflation, then what's the point, right? And this sort of like pie chart here basically just charts how hard it's been to generate the same levels of yields, even lower than back in the 90s, right? But having to use more and more different tools in the toolbox to achieve that. So for us, I think for a lot of investors, by thinking about what do I counterbalance my portfolio with, I do have equities, but I definitely need something that's more stable, more diversified, has a yield so that there is some predictability in my cash flow. How do I achieve that? So one of the things we've been advocating for a lot of investors is to think about multi-asset concept, not just stocks and bonds, but basically everything else in between. So the way we think about that, and why this is so important, again, this is on the next page, it really brings us home, is that if you look at government bond yields, everybody knows this right now, right? It's basically rock bottom, right? It just does not pay the bills anymore. And if you were a pensioner in Europe or in the US, this would be an extremely challenging position right now. I have colleagues in sort of France, for example, who are super excited getting 2% yield. 2% is just not enough in today's world. How do I get 3 to 4, 4 to 5% yields in my portfolio at the moment? So for us, we think having a broad approach does a couple of different things. So on the next page, our philosophy here is very, very straightforward. First of all, we want to make sure that this is the core allocation in your portfolio for this particular strategy. So this strategy we're talking about now is sort of the multi-income strategy that we work with ATR Asset Management on. So what we're trying to do here is give investors a couple of different things. One, we want to make sure you get paid, right? So we want to give you yield, but at the same time, we don't want to go crazy, right? You can still make about 7% yield out there right now by buying certain kinds of high yield bonds. But again, we are still in the middle of finding our way back to the path of recovery. I wouldn't want to be buying a lot of high yield debt right now for a lot of issuers because default risks can be a little bit challenging. So we need to be specific. So we want to give investors yield, but we don't want to overstretch for that yield. All right. Everything we get, we pay out, for example, right? So we don't want to get investors' money, pay a little bit more than what we actually achieve and basically give your money back to you and call that income. We definitely don't want to do that. So we want to make sure that the yield we're giving is attractive, we're not overstretching for it, and we have a really keen eye on the risk management because, again, a lot of moving parts in 2021. The second thing we want to focus on is being diversified, right? I mentioned just right now, everything is priced so much for perfection. Any kind of negative news could really move markets. So for us, having that diversification, splitting yourself up and investing across multiple different countries is kind of the way to go. Do not put your eggs in one basket. This particular strategy right now has exposures about 86 different countries. We have about 15 different asset classes in the portfolio. And in terms of number of securities, we have about 3,500 securities in the portfolio right now. It really doesn't get much more diversified than this, right? And the last point actually is quite interesting. And I think it's the best thing to illustrate on the next page is that we are really leveraging the entire firm. So what does that mean? So the three gentlemen on top there are the lead portfolio managers. They're in charge of the asset allocation. So how much do I like certain countries, certain sectors, certain industries, for example. But once they've made this decision, they work with the asset class specialists and they could sit anywhere across JP Morgan Asset Management. So basically at any point in time, there'll be close to several hundred people working on this particular fund itself. So it's diversified across every conceivable country geography, but also diversified from a process perspective. Because for example, the guys who are running global equities in this portfolio will have a very different process than the guys running emerging market equities, for example. So you really are getting the entire firm within one particular product. So this, and It also shows, because the size of this fund right now is north of $20 billion, right? And it just shows for how a lot of investors are super keen on getting these kinds of exposures, primarily because it is consistent, it pays a yield, and it is diversified. You literally just put it in and you don't have to sort of worry about it, because there will always be active management behind the scenes. And what does that actually look like on the next page? So this is a snapshot of the portfolio right now, and I apologize, it is quite busy, but let's just focus on the left-hand side for now. The left-hand side shows you the portfolio as it stands today, and right now we're relatively positive. So you can see a half-half split between fixed income and equities. Right, within fixed income, you'll notice we do have a lot of different types of fixed income. We've got high yield in the US, we've got global investment grade credit, we've got European high yield, we've got some securitized assets in the US as well, we have some emerging market debt. On the equity side, you notice we're pretty diversified across emerging markets, Europe and the UK, and North America as well. Again, having that positive tilt towards emerging markets, very much in line with our view. And we also invest in some other hybrids as well. So convertible bonds that can convert it into equities, as well as preferred equities right now, which don't give you voting rights, but give you a higher dividend yield. So that's for us really, really interesting allocation that you won't be able to find as a regular investor. Like funds like this don't even exist. Right? So this is quite interesting. Now, I want to highlight something on the next page, which talks a bit about flexibility. So that just shows you a snapshot of our portfolio in time. But this particular page shows you how flexible we've been. So again, don't read too much into this. I'll just describe it roughly. So every single column here is an asset class that we are invested in or have invested in the past. So you can tell, you can see that there's a lot of different things that we can do in the portfolio. But what you notice is these gray bars, these just show you how high and how low we've been in any of these asset classes since the inception of the fund. So again, we really are exercising that flexibility. So no, we're not just buying and holding. If we don't like it, we just don't own it, right? It has to fit those criteria that we set, which is sustainable yield, considerable sort of moderate level of risk for the client's portfolio, and over time has to generate returns. And that looks like, and what that looks like is on the next page, actually. So on the next page, this basically shows you a couple of different things. So those purple columns, that's the yield that we've actually paid out. So this is net cash yield that we've paid out. And this chart goes back to 2011, but I can pull this back to 2007 when we launched the strategy in the beginning. So this has actually gone through 2 financial crises already. And for investors who reinvest that cash, for example, what that shows you is that blue line that just shows you the growth. So you get that compounded growth for that yield going forward over time. And it's been really consistent at paying out those attractive levels of yield over time as interest rates have been coming down. Obviously, we're not guaranteeing levels of yield because we have to move in line with the market, but we will give you the best shot at getting a sustainable and high quality level of yield over time. And that yield is very diversified. So on the next page, you can see how well diversified that is. So on the left column, that just shows you our current positioning. Again, a lot of asset classes there, but it's all on purpose. On the far right, on those horizontal line chart, that shows you the yield that we are getting on each of these asset classes, right? So that just gives you a sense of how we're thinking about positioning, how we're thinking about the yield contribution. And right now, that center column just shows you as a percentage of total yield in the portfolio, what are we getting right now? So again, we're super diversified across where we're getting our yields as well. And my last slide, and I apologize for sort of killing you guys with PowerPoint on a Saturday morning, is how you should be thinking about strategies like this in a year of a recession. All right, so we basically just pulled the last couple of big market drawdowns and showed you the returns over the next 6 months, 12 months, and 24 months. So the best time to invest is always the worst time in terms of gut feel, right? And it's not unusual to have supernormal returns in the first 6 to 12 months of a recovery. Right now, broad equity markets are not even hit 100% yet, for example. Right? If you look at past recoveries, we're talking couple hundred. So right now for investors, this is the time to buy, right? But again, with this particular portfolio, there's no need for market timing. There's no need to be sort of very short-term or strategic or tactical in your sort of investment or deployment, because this particular strategy is designed to be active on purpose. It is designed to serve as a ballast. So as investors this year build out their equity positions, do not neglect the counterweight to basically make sure that as volatility rears its ugly head, you have something in your portfolio that's continuing to be stable and continues to pay out a yield. So I'll stop right there and happy to take any questions, guys. Thank you very much.